So what happened was, because of this risk profile, which was complex and very difficult to understand, the crisis started when interest rates began to rise eventually, and the adjustable rate subprime loans started to default, because loans were given to people who could not actually pay these loans back. And then this started a sequence of things which really has brought us to the stage we are here today. The holders of these securities, CDOs and MBS, they incurred losses. One result was the prices of CDOs fell because nobody wanted to buy these CDOs, these securities. So the market risk came into play. Then the issuers of the securities had to pay CDS. The issuers of the CDS means the swaps, credit default swaps. They had to pay for the losses of the default. And what happened is the financial institutions which were holding the securities, both the collateralized default obligations, CDS and CDOs and CDS, they incurred losses. And they did not have enough capital to back these losses because they were undercapitalized. And this created a scramble to get funds from different sources. But of course, nobody was willing to lend funds because they were not sure whether they'll get their money back. And as a result, the money market froze. And finally, what happened is, from credit risk, the default, we had market risks and liquidity risks, which basically created the final systemic risk where the whole economy has come to a standstill in some countries. Now, this was a brief introduction to the crisis, and now we go to the Islamic perspective. And I have quoted here two Islamic economists on the crisis. One is Dr. Umar Chafra. He has written a paper and presented it at this forum at Islamic Development Bank. He calls for a new architecture, financial architecture, and he explains the crisis on inadequate market discipline, expansion in the size of derivatives, and the policy of too big to fail, which encourages risk-taking. Dr. Nijatullah Siddiqui has stated that the crisis is rooted in the moral failure that leads to exploitation and corruption. And he has a list of four things which has created this crisis: credit or liquidity crunch, overextended leverage, complexity of the products, and speculation and gambling or risk shifting. We are aware that if Islamic principles were used, this crisis would not have happened. And because it would have not allowed some of the instruments which were used in this crisis. Among them, for example, as Professor Chapra has said, if profit loss sharing instruments were used, there would be more monitoring of where the money is going. Islam prohibits selling of debt, so the CDOs wouldn't have been there. There's prohibition on derivatives, the CDSs wouldn't be there. And there's prohibition in short selling. Short selling is used to basically induce run and downturn on failing firms. So all of these instruments are not available or are prohibited in Islamic finance. So the way we see the financial crisis happening wouldn't have happened if these principles were followed. And of course, there is a greed aspect to it, and most of the firms wanted to make money and went into excessive risk-taking and leverage. And we know that in Islam, this is not encouraged. But, now comes the but. There is a difference between the principles and practice of Islamic finance. If you see what happened in the crisis, it's basically three main points. The financial institutions operated in a deregulated environment, and financial institutions seeking higher rates of profit, the greed component, and they went into excessive risk-taking, and they used innovative complex instruments to get this profit. Now, my submission here is that if Islamic finance follows the same path, can we end up in the same situation? I feel that the practice of Islamic finance has been such that we are moving in that direction. And we see that the regulatory environment of Islamic finance is getting better, but it's not very strong. And part of it is because the industry is evolving. It's very difficult to understand the risks in different instruments. As for the second part of the problem, financial institutions seeking higher profits, we see that it's a moral component which cannot be preached to Islamic financial institutions. And we have seen episodes of speculation in especially the Gulf countries lately, where they were run on the stock market. And also if you look at the property market in Dubai, people are saying that it's a bubble which is kind of in the making. And if you look at some of the financial innovations and, or the instruments which have been developed, we see that they have features which created this crisis. For example, very few instruments are based on profit loss sharing. Most of them are fixed income assets, very close to the conventional products. Then we have Sukuk. Which basically is transferring or breaking the link between the financier and the user of funds. And then we have now recent development is the swaps which are coming in. And the swaps are basically, the swaps are structured in a way where you can transfer the returns of the assets you own to others and take the returns of other assets on yourself. And these other assets can be, the way it is structured, can be non-Islamic or haram assets. So basically, using this instrument, you could have taken the risk of these CDOs which were out in the market.